Investors and traders, welcome to the channel Market Chart Pattern. Today is 30th of June 2024. I hope everyone is having a great weekend. 30th of June is the end of the first half of the year. Time is just moving really quickly. It's also the end of the month, and really it's been a very interesting year so far. A number of things did happen, and it was also a really important week in the markets which just finished. So we'll be talking about that. In particular, we'll be taking a look at the bond markets and the US dollar. All right, okay. So as always, this video is for educational purposes only, and it is not a financial advice. I'm also bringing the weekly and the daily ranges to be expected. 1st of July, these are on the top half. You see the weekly ranges, and on the bottom half is the daily ranges to be expected for 1st of July. 4th of July is the America's holiday, and the markets will be closed, so it will be a little shorter week. So there we go, and I'm gonna move it away here. So this is the chart of Dow Jones Industrial Cash Index. This is where we look at our timing model. So it is also a cycle analysis, and we are approaching a very key date which comes in next Monday, 1st of July 2024. And as you guys know, the subscribers who have been following us for quite a while, this model has actually picked up some really key dates at some really important turning points. And the way it works with the timing is that we have to give it 2 to 3 trading days on either side. And what we saw last Friday is some of the indices closing a little bit lower, such as the NASDAQ and the SP500. So we will get to that as well. So keep this in mind. 1st of July is this is where we are getting our timing as well. Just looking at the pattern, we have the one-to-one price projection. The market is in a range between the 61.8% and 78.6% retracement for this swing. Okay, so with that, we will move on to the bond markets. But before we do that, I am actually going to show you something here, and let's actually take a look at this. So this is coming from the website tradingeconomics.com, and what we are looking at is basically a chart of, let me bring it like this, oops, a little bit lower like this. This is the containerized freight index, right? And what we can see is that since the beginning of 2024, and also there was a, so there we go. So we saw a dip since the beginning of 2024 right into March of 2024, and now we are looking at a rather steep acceleration which took place here, right? When we are getting this data, maybe it's a little bit delayed, so the June data is not there, but we should get it quite soon because the month has ended. So it looks like there is another spike coming in the containerized freight, and if all this history I've selected all here, and we can see there was a big peak which came in December of 2021, and this is that period where the container freights were going crazy because of the shortages of the containers availability, and the container rates were going as high as $24,000, $25,000 from China to the West Coast, so the port in Long Beach, California, for example. You know, that impacted a lot in terms of there is so much product which is imported from overseas, from Far East, and if just the container freight is going higher, that is actually going to impact the import costs. Excuse me, which means that higher prices are to be expected. So that actually was a big component in terms of the kind of inflation that we have seen. And if the container prices are on the rise again, I'm not sure whether this peak will be challenged again, but certainly there is a big sharp rise here. You know, we are looking at another spike, so of course that is going to impact inflation data, and inflation data is a little bit lagging. You know, it needs to be collected, statistical analysis put forward, so that could have an impact in terms of what the Federal Reserve was planning to do. and they've already pushed the interest rate cut to just one cut towards the end of the year. Now, just moving a little bit lower here, here we have the list of different indices. So this is the Baltic Dry Index. This is for big cargo ships which carry the dry freight, such as iron ore, grains, etc. And what we can see is this month, this is the June 28th date here, has seen a 14.53% jump in it, and this index is high about 84% this year in 2024. So these are these big, massive ships which carry the dry freight, iron ore. You could look at grains, for example, amongst other commodities. So if it's an indication that the freight rates for these commodities is going higher, of course it will have an implication towards inflation as well. And this is the Goldman Sachs Commodity Index, and this one is also higher, 14.52% for the year, but for the month it was down about minus 1.56%. And this one is another consumed commodity index. I don't know what this index is, but this one is down. And then the other interesting one is right here. This is the one which we had a look at on the chart. Containerized freight index. It's up for that month, June 28th date, 37.39% in that month. So the month of June, it spiked up a fair amount. And look, since the beginning of the year, it's up 300%. So the events in the geopolitical events taking place is definitely impacting this market. And if the container freight rates are going to go higher, and they have already been higher by 300%, then it's going to have an impact on the inflation. Okay, with that, we'll also take a quick look at the kind of economic data that might be coming out next week. And here the timing is these are London times, so you'll have to actually adjust them for the Eastern. So we'll have next Monday the ISM manufacturing PMI figures coming out. So this one is red, so this is likely to impact the market. 2nd of July, for the US, we have the JOLTS job coming out, and Fed chair is speaking, so Powell is speaking, so that's always an important one. That's pretty much the timing when the market will open. So it's going to be 9:30 Eastern time zone, 3rd of July. We have the unemployment claims coming out, and then ISM services PMI coming out as well. And then towards the later in the afternoon, we'll have the FOMC meeting minutes coming out, so keep an eye on it. 4th of July, a holiday in the United States. And then Friday, we have some other economic data coming out. We'll have the non-farm payrolls coming out, so that's really important. Along with the unemployment rate. So a fairly heavy week for the economic data because of the non-farm payroll. And then, of course, it is a shortened week as well. Now, let's take a look at the bond market. And I'm going to start with the US Treasury 2-year note. And this is the chart which shows the yields on the y-axis. And here, what we saw last Friday is when the economic data came out, which was related to inflation, we saw a spike here. And we actually saw pretty dramatic moves in the bond markets. We'll take a look at that. And here what we have is this 4.7% level seems to be a pretty difficult level to break to the downside. And we have been actually looking for this market or the yields to move lower based on our analysis that we actually might be in this head and shoulder pattern, and then in this bigger ABCD black 1-to-1 price projection, which would in fact see the yields move 3.9% to 3.9%. But this all depends upon this 4.7% level being broken to the downside convincingly, and what we can see is over the course of several days it just keeps on finding support from here, and it was a pretty big spike here. So that's a really key point to note. because then the bond market is telling us something that we need to listen to. And if the yields keep on rising, then of course we have got the stock market trading at certain levels that we have been watching. So it's very close to those levels, already reached those levels and those patterns. And then we could see some sort of a rotation lower. That possibility remains there. Now let's move down to the 10-year treasury note. It's a really big market. This market is bigger than the 30-year long bond futures market. And here we had this retracement come right to the 61.8% of this entire move. So you can see this brown line here. Now, because it had broken certain key patterns and levels, one of them was this bearish symmetry concept, that every time the market was rallying by this much, the sellers would come in and push the market lower, and that pattern actually broke when we had an ABCD here. But this market is finding a pretty strong resistance at the 61.8% retracement. Now, the month of July seasonally is actually friendly to the bonds, in the sense the bonds usually rally during this certain part of the month of June, and we have seen a nice rally come in, but the rally also is stalling at the 61.8% retracement. So it's direct market feedback that, you know, if this pattern that we have been watching, this blue line where we can see this market go as high as 115, it really needs to get above this 61.8% retracement, or around 111 level. Now this kind of a move, to see the market move this much, this is not this is quite rare, but it's been happening. Similar kind of moves are happening now, because the market is so much sensitive to the inflation data, and we have seen a move like this a little while ago as well, where we can see the market actually move down like this, but only to reverse after a couple of days. So right now the market pulled back from this 61.8% retracement, and it's really right at the 200-day moving average, and we have the 89 period moving average just hanging around a little bit lower as well. So there is some support around here. Now the key thing is how this market is going to trade in terms of price action. If we are not able to see a reversal taking place within a 2 to 3 trading days range, then chances are this market is actually heading back lower and maybe close this gap that we see on this daily chart, but this gap is actually coming in because of a rollover here. So really precarious situation. The kind of pattern that we are watching, the market did break certain levels, and it looked like it is moving in that one, but we are actually seeing some pressure come in right from the 61.8% retracement. So now really key thing is that market breaks above this 111 level for it to remain in this CD leg higher. And then if we move to the 30-year bond futures, here we can see this move was pretty dramatic here on last Friday, because bonds are more volatile. They're also a little smaller market compared to the 10-year treasury notes. The moves are usually more exaggerated, and here what we can see is that the market has actually also completed. This is when it happens. Such a similar kind of a price move happened previously. The market has actually pretty much done that, and also this market is sitting right at the 200-day moving average. So maybe it can pull back a little bit further, touch this upper part of the trend line, and yeah, really we're looking at next 2 to 3 trading days to give us clue whether what we thought it was going to do in terms of being in the CD leg higher, the market is actually going to do that, or it is in fact a big ABCD pattern here, which I've drawn in this brown line here, coming right from the 61.8% retracement, and it was exact level on the 10-year treasury note, and the market might actually be now rotating lower. So that possibility is now coming back. So really key to watch the bond markets now, because if the yields keep on spiking up, then it is going to impact risky assets such as stocks, and it makes sense as well, because if the rates are going higher in a asset which has way less risk involved, such as treasuries, then the money is likely to move to get higher rates. So there could be fixed deposits could be done, and coupons could be collected. Here again, this is the iShares TLT, 20 plus years duration bonds in this ETF, and it actually broke above the 90 to 40 level that we were watching for. And let's draw this. Here we go. I believe it's also very close to 61.8% retracement, and this is where the market went to. And maybe it has a little bit further to pull back, and we have this trend line here. So really watching really carefully what the bonds are likely to do, and if they keep on breaking lower, then the CD leg that we were looking for, we might have to put it off the table. But right now I'm still going to keep it here, and really watching these price action in bonds very, very carefully. Okay, now let's move to dollar index. Here we go. So the dollar index, dollar has been pretty stable. In fact, it's resilient is the word that we need to use. And here it has retraced quite a bit, about 61.8%, slightly above that. And we have actually thought that 107 level was a key resistance level, and the market is likely to rotate lower. The US dollar is likely to weaken against a basket of currencies. But since Friday, 7th of June 2024, there is a possibility we could be in an ABCD move higher. Now on the daily chart, we have seen some sideways price action come in, and it has come in pretty much right from the let me actually draw this. Looks like the 78.6% retracement, and we also see a double top, a potential double top formation here. So top, and then 28th of June, and the market actually closed lower. So interesting development here for this ABCD to move higher and take out 107. The market needs to move above 105.77, which is 78.6% retracement. It is more clearly visible on the weekly chart. So here we go. Let me actually make it in this format of candles. Here we go. And what we are talking about is this, what you see here, the ABCD in red. But it really needs to get above the 105.77, 105.80 level to move in this ABCD higher. So I've got it as a question mark because the chances still are that this 107 is a pretty strong resistance level, and we can see the US dollar actually move lower, but it's been pretty resilient thus far. All right, okay, so now with that, we will actually on the flip side take a look at the Euro USD, because Euro is about 51% of the dollar index, which is a basket of currencies. And as we see the dollar kind of stall at the 78.6% retracement, we see the Euro USD go into a trading range around here. And if we just take a retracement, so it's just the opposite. You can see it's the 78.6% retracement for the euro. So it looks like the euro is actually getting ready to make a move higher, and possibly it's gonna be in this ABCD format, which means that the dollar is looking to move lower, and that's gonna be pretty interesting because that weekly format, weekly pattern ABCD we were looking at in US dollar might not actually play out. But how will we know whether it's gonna do that? What we'll do is we'll take a retracement right here, and then we will draw a 38.2% retracement. There we go. We also have the swing high here. So what it means is if the market begins to close higher than 107.70 for example, then, and we really need to see 2 consecutive closing days above this level, then the chances increase that we might be actually in a confirmed ABCD higher. So that will be an interesting situation. Now, if we just take a look at the Bitcoin. Now the Bitcoin has actually been rotating lower, and looks like it might wants to touch 54,000, which is the ABCD pattern. Massive candle formation here on the 24th of June. That was last Monday, and the price has just been remain, it's just consolidating in this mother candle. Now the chances for it to move to 54,000 will happen if it breaks below this 58,500 level, and of course if it breaks above this mother candle, then that's actually more positive. So it's a pretty big range between 58,500 to 63,300, or 250 roughly speaking. Moves quite a bit. Momentum is actually shorter term negative for this, but you can see the 200-day moving average is just around 58,000 level. So interesting formation. I had done a video on the Lucas cycles, and then how the cycle actually predicted a top in this market, and we have not seen higher prices since then. Now I will do, when I get some time, a follow-up to get the next Lucas dates, but what we can see is for several months, we are coming up to almost 4 months now, that this market has been contained in a big range. So that Lucas spiral does give us a fantastic information for this market. Okay, now what we'll do is we'll take a brief look at the gold market. And my computer is slow, apologies. This is the gold market daily chart. This is the COMEX gold. It is not the spot gold, so the prices you'll see might be will be different to the spot market, because quite a lot of people actually look at the spot market. This is futures traded on the COMEX, and here what we see is the possibility for the market to still move a little bit lower, come down to around the 2,280 level. Although last couple of days we have seen a fair amount of volatility in this market, and trading range formation here, but looks like we might still be able to see slightly lower prices. Longer term, as you guys know, we are bullish on this market with targets as high as 2,700. So 2,500 for by that will be 2,700 to complete this bigger ABCD. But of course, gold can go into short-term correction and also sideways market. But looks like the big move in gold is not there yet, and the market is going to chop around, consolidate for quite some time before it makes that next move higher, in my opinion. Okay, now we'll begin to take a look at the stock indices. So let's start with the S&P 500 cash index. Here we go. Daily chart of S&P 500 cash index, and here what do we have here? Interesting is that we have a kind of a double top formation here. The market went above fairly quite a few points, about 20 points higher than the high of 20th of June, and then sellers came in, or the buyers decided to take profit, whatever, and the market closed lower like this. So it's not a very good looking candle, but again, these are early days. But just to remind that we did have a timing come in 1st of July, but again 2 to 3 trading days either side is something which we like to take a look at. Further, from a pattern perspective, the market was really at this 1.618 expansion, something that we had been talking about for quite some time. So around that levels, just in our trading range formation. And now on the daily, I don't think I did an ABCD on the daily. No, so this one is actually not valid. Now what I'll do is I will just move to the weekly chart, and here we go. So here on the weekly chart, what we have been targeting is 5650. That's the red box that we see. So the market seems to be creeping higher, but then again, what we see is this market, also getting it towards more of a trading range market now, and with the next week being a shorter week, holiday week, we could see actually volumes not that great in the market. And if we, so let's take a look at this. Was the market actually closed pretty much unchanged, and look, a lot of trading actually took place here from a volume side of things. Now, how do I turn this off? Here we go. Okay. So we still target 56.50, but again, the market is pretty extended, and you can see that these levels that we had been forecasting months in advance, the market has been reaching this. So we actually view this as a target. But when we do have the timing come in, and when the price meets time, the pattern is complete, and we have seen pullbacks happen. So here, really watching this level, I think we might actually get to this level. Whether it will happen in next week, I do not know, but it remains a target that the market might actually be able to achieve. Okay, and now let's take a look at the NASDAQ. Excuse me, should have done the S&P 500 futures. All right, so the futures market, a little bit different scenario. What we can see is right at that level, 1.618 expansion of the entire 2022 bear market, and also this smaller swing. Let me actually draw it for you. Here we go. There we go. When we have a confluence of two or more, it's something we always pay close attention to. So this level where the futures market is trading right here, right now, it's very important. And with the timing coming in next week, is I think really important what the market is likely to do. And looks like there might be a smaller ABCD here, which I have not drawn. And let's see. And there we go. So I think we have three things now. We have 1.618 expansion of the entire 2022 bear market coming around 55.69 or 55.70 roughly. We have the 1.618 expansion of this smaller swing here coming around 55.65, and then we also have the ABCD of the smaller swing here. So I wouldn't be surprised to see a few hundred points pullback to take place, just because the market is reaching the kind of levels that we had been watching for, and we have this confluence and also the timing come up. So really interesting what is happening in the futures market. Now let's move to the NASDAQ 100. We'll take a look at the futures market here. Ultimately, we think the target is this 20,750. The market actually came pretty close to that, 20,350. It's a short by about 400 points. But if you look at when these levels were forecasted and the market came pretty close to it, I think we have to give it credit. Still possible that the market is actually likely to hit this, and here we have the 1.618 expansion of the entire bear market, and also this big ABCD blue, in the green coming around here. So when we'll have a confluence of two things coming together, so it will be really interesting to see the price action taking place when we get through that level. If we get there, we have already begun to see some sort of consolidation taking place. Not really surprised, because we are approaching certain key levels, and also from a price perspective, and also timing as well. So it's a pullback could be in play, is actually looking more likely as a scenario. And what will tell us of that, the significance of this, will come from here. So we'll really have to watch the if we are watching to the downside, the standard deviation levels. So if these -2 standard deviation levels, the market actually begins to close lower than these levels, and that is going to be a pretty rare instance. So for example, the NQ closing below this will be an indication that maybe some bigger correction is in play. So this is how I will actually really closely watch these weekly standard deviation levels for us to be able to gauge if there is a bigger pullback which is coming into play. So this is we'll watch it, and of course we'll also look at the Fibonacci levels and put these things together. So really interesting where the market is going. And if we just also take a look at the cash market, which is the QQQ, the QQQ is yeah, it's similar situation to the NASDAQ 100 weekly chart at 20,750. This 504, maybe the market is able to get there. And if we take a look at the XLK, XLK, slightly different pattern. It has already completed its ABCD, the big one, went above the 1.6 minute expansion. So it's kind of consolidating here, but slightly different pattern to the QQQ. And in my opinion, it has actually completed it. So I had a question mark here. I'm going to remove this question mark just because, you know, at that time when we were forecasting this level, I put a question mark whether the market will reach to that level or not, but it did. So there's no now we can remove that, and that also shows that, you know, how these one-to-one price projections actually work, and they give us a pretty good turning points at times. And here, you know, we have these several of these smaller ABCDs, like the purple one completing around here as well. So the market is or has reached these really key price levels that we forecasted months in advance, and now we are watching price action really carefully, especially on the shorter time frames such as the daily charts. Okay, now let's take a look at the Dow Jones. Here we go. So the Dow Jones has been really interesting because at one time it looked much weaker, and certainly what it shows is that there is some sort of rotation going on, and of course that is all dependent upon the outlook for the inflation. If there is an expectation that the interest rates reduction, which the Fed spoke about, could be actually totally moved out from 2024 because of the data coming harder than expected. And I showed you a few things right at the beginning, such as the bulky dry index, the container freight rates going higher, which could influence the inflation data to be expected later in the year. Then, you know, the growth stocks could get some of the growth stocks could get hit, and the market is already getting thin in the sense that a lot of money is moving in certain kind of stocks with very well capitalized balance sheets, such as Apple, Microsoft, and of course the AI revolution, Nvidia, and AI tech related stocks. But it could also get to a point where investors begin to get out of these stocks, and you know, if so many investors have moved into these stocks and don't want to move out of these all at the same time, then we could see some price action. And what we have seen over the course of few trading days and weeks in this index is that it found support right from the 78.6% retracement, and it's just been chopping higher. Now it's not reached the kind of levels some of the other indices have. For example, it has not taken out the April high yet, so it's just actually trading in a massive trading range. But as long as it remains above the 78.6% retracement, it just could chop around here. A pretty big, massive trading range of 2,000 points that at time is pretty scary. But nonetheless, we should point out this. We have this a top and a recovery high. So rather top in place, and now, you know, if that could just be a double top kind of scenario as well. But in my opinion, the market just might chop around in this range between 37,500 to 40,300 or 40,400. A pretty large range, and you know, of course, we can move a little bit lower and come and test these highs around the 36,880 as well. That's also possible. So this is what we are looking at. This the different indices are showing different kind of patterns, and there is certainly some sort of rotation taking place in stocks beneath these indices. And last but not least, Russell 2000. As mentioned before, this one is also moving in a trading range, and here we can see that it went for a very long time in a trading range. In my opinion, it's again in a trading range, and yeah, there's a possibility it could rotate lower, touch this bottom end of the range as well, and it will still be fine because we could have this ABCD here. which we are watching, and this is point C for us. So as long as it does not break this 38.2% 1922, that's the level. To the downside, the chances for it to remain on the upside are there in this ABCD, but it could take quite a while and a lot of patience, and the market could just chop around in this fairly wide trading range, just the kind of way it had done right here, till some sort of things, the expectation with regards to the inflation coming down begin to improve, of course data dependent. Now if we just move for this one to the daily chart, just wanted to show you this. On the daily chart, what we see is this index actually did something a little bit different. I showed you the S&P 500, and also we can look at take a look at the NASDAQ 100. Those markets actually closed lower for the day, but this one did not. It closed higher. So actually, let's have a quick look on the daily chart of the NASDAQ 100. Closed lower. ES on the daily chart closed lower. Dow Jones, let's take a look at it. Closed pretty much unchanged, but still slightly positive. So actually, let's take a look at, to be precise, yeah, it's just closed by -1 point. So that kind of supports the thesis I was putting out around with regards to some sort of rotation taking place as the expectation for the inflation fluctuate. Okay, now really let's take a look at this New York Stock Exchange composite as well. And here what we can see is this index, because it also has ADRs for some foreign currency companies trading on New York Stock Exchange. So it's good to also take a look at this one. It remains supported by this 17,870 level, and we had 50%, 61.8% retracement. The 89 period moving average slightly below. So again, trading range of here. This is what it looks like. And could it be moving in an ABCD higher towards 18,595? That remains there. But again, with the timing coming in and the two main indices brought in, is S&P 500 and NASDAQ, they closed lower for the day. I think we should be watching these markets with electricity for next week. And we keep on watching our standard deviation levels here, especially these weekly ones, right? So this is how I will be approaching the market for next week. So again, thank you very much for watching the video. Apologies, it's been a quite long video and I was not able to take a look at the sectors. So maybe during the week I will do a separate video in which we just take a look at the sectors and some of really quick look at some of the major indices and other markets. And next week I think I will also do a video on the financial stocks that we take a look at. Apologies, I was not able to do these videos because I was traveling, so I spent about 3 days just in that and recovering. So I wasn't able to put out a lot of videos this weekend. So thank you very much for watching the video. Good luck, good trading, and speak to you guys soon, and have a fantastic weekend.